face it, every investor dreams of effortless, income-generating investments as a path to financial freedom. We're talking stress-free investments where the money makes itself. Nevertheless, only one strategy stands the test of time: dividend stock investing. But here lies the million-dollar question. Which dividend stocks are the right ones? Can they truly provide financial security? Regardless of your level of experience, we all seek guidance. And who's a better guide than the Oracle of Omaha himself?
Recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them.
Today, we'll be taking a page off Warren Buffett's book to unveil the top 7 buy and hold forever dividend stocks. We'll tell you why they need to be in your portfolio, how to offer a reliable income stream, and the potential for exponential wealth growth. Are you ready to take that giant leap in securing your financial future? Warren Buffett is a name that hardly needs introduction. Fondly called the Oracle of Omaha, his reputation precedes him in the investment world. He never shies away from sharing his intellect, practices, and know-how when it comes to picking up value-generating stocks.
I think every business should be run as efficiently as possible, and some are and some aren't. We try to buy the ones that are.
His wisdom, earned through immense success, emphasizes long-term value over short-term gains. He seeks out companies with robust fundamentals and competitive advantages, prioritizing their potential to sustain and increase dividends over time. To him, a moderate dividend yield from a strong company surpasses a high yield from an unstable one. It's a waiting game, and Buffett is the master of it. So let's cut to the chase and unveil the 7 best options for your portfolio. Number 7, HP.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones, companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
If you like the idea of tech stocks paying an above-average yield, why haven't you invested in HP already? We can all agree Buffett hardly ever invests in tech stocks, right? That being said, don't you think the fact that Berkshire Hathaway has made a notable exception here screams volumes? They hold an impressive 12.3% stake in HP, making it one of the conglomerate's largest holdings. In the first quarter of 2022, HP's prospects began to entice Buffett, forcing Berkshire to gain ownership of a staggering 121 million shares in the tech firm. Of course, this caused a frenzy, leading to a rapid 15% increase in HP's share price. The amazing thing about HP is that it has a glowing track record of increasing dividends for 13 consecutive years, boasting a healthy dividend yield of 3.5%. Despite some of its recent challenges in revenue generation, nothing is stopping its dividends. First, the management focuses on a balanced debt-to-profit ratio to maintain a healthy balance sheet. Secondly, they're actively reducing costs to ensure sufficient cash flow for growth and dividends. And as if that wasn't enough, HP is strategically investing in areas with long-term potential, such as remote work solutions and subscription-based printing services. As the economy improves, HP's printing and consumer PC businesses are expected to rebound. And with a forward PE ratio of just 9, it's no wonder why Berkshire is banking on it. Number 6, JP Morgan.
They're businesses I understand, and I like the price at which they're selling relative to their future prospects. I think 10 years from now that they'll be worth more money, and I feel there's a very high probability I'm right. And I don't think they will turn out to be the best investments at all.
Warren Buffett regretting the financial decision is a rare occurrence. But boy, did he do so for the 6th stock on our list. Speaking to Yahoo Finance editor-in-chief Andy Sewer in a wide-ranging interview, Buffett boldly stated, "I should have bought JP Morgan. I wish we bought a lot more. I made a mistake." Now, while most income investors seek high-yield dividend stocks, a lot seem to forget the golden rule. There is always more than meets the eye. Steady earnings, ample cash reserves, and liquidity are crucial for consistently cashing out dividends. Furthermore, a stock's ability to generate robust returns year after year is vital, combining capital appreciation with dividends. And that's why JP Morgan Chase is a great place to start. It stands out in all these aspects. The Zacks consensus estimate for JP Morgan earnings has seen positive revisions, indicating optimism for the future. As a matter of fact, did you know JPM currently holds a strong buy rank? In terms of performance, its shares surged north of 15% this year, significantly outperforming the industry's growth. Also, JP Morgan has achieved an impressive 12.5% earnings growth in the past 3 to 5 years, surpassing the industry average of 6.1%. The juicy part is that the upward trend will likely continue, with a projected earnings growth of 24.8% in 2023. JP Morgan has been strategically expanding its reach through domestic and international acquisitions, diversifying its revenue streams, and after clearing the 2023 stress test, the company plans to increase its dividend by 5% to $1.05 per share, accompanied by a share repurchase program. This makes JP Morgan Chase a solid option for investors seeking a dividend stock to hold for years that delivers consistently, regardless of market conditions. Number 5. Occidental Petroleum.
If we're in an oil stock, it's because we think it offers a lot of value at this price.
Moving on to the 5th dividend stock on our list, we have Occidental Petroleum, or OXY. A company that has been making waves on the market, and not just because of the fact that it clocked an impressive 91% stock rise over the past year, just months ago. You see, Berkshire Hathaway's stake in Occidental surpassed 20% last year amid Russia's invasion of Ukraine. By March, the stake had grown to approximately 23.6% of the company, roughly translating to around 211.7 million shares worth about $13 billion. Yikes! Nonetheless, have you ever stopped to consider what's so special in Occidental that merits such a substantial investment? To start with, Occidental shines like a million stars when the topic of technology comes around, boasting some of the industry's most efficient drilling practices. Also, Occidental impressively held around 23% of the best-performing wells during the Anadarko acquisition, despite having less than 5% of the total Permian Basin wells. Furthermore, Occidental promises a massive future potential, as seen in its commitment to invest in low-carbon technologies. While it appears cheap with a low P/E ratio today, you should be reminded that Buffett's investment philosophy of holding stocks for the long term aligns well with Occidental's deep inventory of projects and high productivity technology. With the firm's appeal spreading across the present, near future, and far-off future, it's no surprise that it has become a significant part of Berkshire Hathaway's portfolio. Number 4. United Parcel Service. At number 4, we have the United Parcel Service, an economic bellwether, for good reason. The package delivery, shipping, and logistics provider is admittedly a global titan that is vital to several industries. But here is why the UPS stock is an attractive buy right now. As the largest courier company globally, the firm generated an excess of $100.3 billion in revenue in 2022. With 78% originating domestically. One of the key factors why you need to consider snapping up UPS stock now is solid free cash flow, which enables strategic investments. In 2021 alone, did you know that UPS repurchased shares worth $500 million? UPS has one of the best dividend track records out there. Its board of directors recently raised the quarterly cash dividend to $1.62 per share, effective from the first quarter of 2023, marking the 14th consecutive year of dividend increases. While the current 3.5% dividend yield might not be groundbreaking, you should know that it is twice the 1.6 yield of the S&P 500, making it highly competitive among other large-cap companies. As if that wasn't already juicy enough, UPS has approved a $5 billion share repurchase program for 2023, alongside expected dividend payments of $5.4 billion. Finally, it has a modest net debt of $11.7 billion, compared to its $156 billion market cap, pointing to the prospect of future dividend growth. While there are concerns about a potential global economic slowdown impacting earnings expectations, UPS remains a strong choice, with projected EPS softening in 2023 before rebounding in 2024. Number 3. Johnson & Johnson. Coming in at third place is the healthcare giant Johnson & Johnson, a company that we dare say is Buffett's most surprising pick on the list. You see, Berkshire Hathaway, over its lengthy history, hardly ever delves into healthcare stocks. Yet for some reason, J&J seamlessly fits into the Oracle of Omaha's pattern of investing. For years, Berkshire hasn't, and probably would never completely abandon the firm in any season. But why?
Or you name it, Johnson & Johnson. We don't know which of those will come up with a blockbuster commercial drug 3 or 4 years from now, and we don't try to assess it. What we do feel is that we have a group of those companies bought at reasonable prices, that overall pharma will do well, maybe not quite as well as they have in the past, but they're doing something enormously important. They're doing something that should offer chances for decent profits.
Over the years, Buffett has been prone to invest in firms that generate substantial cash flow and consistently return it to shareholders through dividends and share repurchases. Not only does Johnson & Johnson tailor this approach, but also they're one of the best at it. Would you believe that they have returned over 70% of its substantial free cash flows to shareholders over the last decade? The fact that J&J also boasts an impressive streak of over 6 decades of annual dividend increase just feels like overkill. With its history of growing dividends, Johnson & Johnson has become a favorite blue-chip dividend stock. It serves as a dependable source of income for conservative investors, a stability that is reflected in the growing number of hedge funds holding stakes in J&J, which have a consolidated value of over $4.5 billion. The constant demand for drugs, devices, and services has helped J&J grow its adjusted operational earnings annually for 35 years, leading up to the COVID-19 pandemic, and don't think for a second that things would change. The firm stands head and shoulders above its peers as a no-brainer buy in 2023. Number 2. MasterCard. Moving on to one of the world's top electric payments, this is MasterCard, second place on our list. With a market value of $192.7 billion and a modest dividend yield of 0.5%, MasterCard has caught Warren Buffett's attention for all the right reasons. As you already know, the Oracle of Omaha has a knack for seeking a company with the potential for profitable long-term growth, emphasizing that time is the friend of the wonderful business, the enemy of the mediocre.
Stocks are safe for the long run, and they're very unsafe for tomorrow.
With that in mind, why do you think Berkshire Hathaway initiated its stake in MasterCard back in 2011? It's easy. They recognize the enduring trend of consumers and businesses moving away from cash and checks in favor of electronic payment methods. Rather than issuing credit cards or extending credit, MasterCard provides transaction processing services, earning a percentage of each sales dollar processed over its payment network and mitigating the risks associated with traditional banking activities. According to estimates, MasterCard has a market opportunity for capturing payment flows around $225 trillion, indicating substantial growth potential despite its already overwhelming business presence. Although MasterCard's share price has shown remarkable growth, with a 96% increase over the past 5 years, its stance as a leader in the electronic payment industry makes it a strong candidate for everyone to buy and hold in their dividend stock portfolio. Number 1. Visa. In 2011, just like MasterCard, Berkshire Hathaway recognized the immense potential of Visa, a company that thrives in the era of rising digital payments. You see, Visa has experienced double-digit growth in payment volume. And believe it or not, there are more than 3.2 billion Visa-branded cards in circulation today, a figure that keeps on growing no matter how absurd it seems. Visa's sheer scale and capital-efficient operations have propelled it to an operating margin of over 60%. This financial strength has enabled Visa to compound its dividend at an impressive rate of more than 20% annually over the past 5 years. The company's revenue growth is expected to average 10% annually over the next 5 years. And with its low payout ratio near 20%, everything points to the direction of robust dividend growth. In a world where cash is becoming less prevalent, Visa is primed to reap the rewards of the digital payment revolution. Now, we admit at first glance, Visa's 0.7% dividend yield isn't exactly exciting. After all, that's less than half of the 1.5% yield that the S&P 500 index offers. But the only reason for this low dividend yield is the company's tremendous stock price growth rate over the past decade. Did you know that a $1,000 investment in Visa a decade ago would be worth around $5,500 today with dividends reinvested? This is far more than the $3,200 the same investment amount in the S&P 500 would be worth right now. If you are seeking remarkable dividend growth in the long term, there aren't a lot of firms that have better prospects than Visa, if there are any at all. All of these solidify its place as the #1 dividend stock on our list.